Okay, let's continue. Um, yeah, so in the previous video, we talked about how empirically, using historical data, we can see that riskier portfolios generate a greater return on average over time. Okay, but they're exposed to more volatility, as we see here in the red line. Okay, so ultimately, your portfolio choice comes down to a risk return trade off. Okay, as you see here, if you go with the safer security, the on the y-axis we have historical volatility, the volatility risk, and historical average return, the return, right? Return versus risk. For something safe like the treasury bill, the volatility would be like 3%, but the expected return is also, or the historical return is only 4%. For corporate bonds, maybe this is like 7% and maybe 6%. For S&P 500, the largest 500 stocks in the US, maybe 21% and 12% return, okay, and so on. As you can see, as the risk increases, the historical annual returns also increase. Okay, but you're exposing yourself to more risk if you choose to go with these riskier securities. Okay, so there's a trade-off. Yeah. So here's like a decision rule. Okay, if you're picking a portfolio, there are these basic rules to maximize your expected return. Okay, the goal here is to either maximize expected return and or to minimize risk. Okay, so all else equal, we want the greatest expected return, but then we want the lowest risk possible. Okay, we're still assuming risk aversion. Okay, so here are the rules. If A and B have the same expected return, one with lower risk is superior. Okay, so it's yeah. And the second rule is if A and B have the same amount of risk, one with the higher expected return is superior. Okay, so let's look at this graph, a little chart that I made up. On the x-axis, we still have risk. On the y-axis, we have expected return. So we have 1, 2, 3, 4, and 5. We'll consider these 4 different securities or portfolios. If we compare 1 and 2, which one is better? Okay, try to answer it yourself, and I'll tell you. So based on this decision rule, this falls under this category. 1 and 2 both have a 3% risk, 3% volatility. 1 has a 3% expected return, 2 has a 5% expected return. So 2 is clearly superior compared to 1. Okay, that is, we're following this rule. If A and B have the same amount of risk of 3%, one with higher expected return is clearly better. Okay, let's look at 3 and 4. Okay, which one's better? 3 and 4, we're going to use this rule. The first one, if A and B have the same expected return, they both have a 10% expected return, right? 3 and 4. But 3 has a lower risk compared to 4. So 3 has about a 5% risk volatility. 4 has a 7% volatility. So they're both generating a 10% expected return, but this one has lower risk, so 3 would be superior. Okay? So usually in class I also ask, how about 4 and 5? 4 and 5. 4 versus 5. Think about it. 4 is clearly better. Okay? 4 has a lower volatility compared to 5, 7 is lower than 10, but it's generating a greater expected return, 10 versus 8. So it's better on both fronts, expected return and lower risk. Okay. How about this last one's a little bit more tricky. How about 2 and 3? Okay. This one, there's no clear answer. Okay, so we say between 2 and 3. If we lived in a world where only these 5 securities existed, then both are actually good choices. Okay, 2 is the best among securities with 3% risk. 3 is the best choice among securities with 10% return, right? So the choice between 2 and 3 depends on your risk preference. So if we go back to the little tape figure here, you can see that small stocks in S&P 500, we have the red line and the blue line, right? Some people don't like this much volatility. This means you could lose about like 80% of your savings or your investment if things get really bad. Okay, some people don't like that at all. Okay, they would rather forego some of this return if they can lower the risk. Okay, if you look at the blue line, it only falls to like this down here. Maybe you're losing 30%. Okay, so it depends on your risk appetite. Okay, risk preference. So in this little example, over a 90-year period, the smaller stock was clearly better, but maybe, some people, if you're investing for like 20, 30 years, it could be different, okay? But as the investment duration gets longer and longer, I would say 3 is probably better, okay? But for the purposes of this course, we'll say 2 and 3 are both good. Depends on your risk preference or risk tolerance. Everyone has a different risk tolerance. Okay. Now one more thing while we're here, let me just clean this up. Yeah. So another way to look at this is, we're not going to cover this, well, I'm going to mention it, but you don't need to know this for the exam. We can try to come up with a measure. There's a measure called the Sharpe ratio in finance. Ratio. Okay. So what it is we're gonna look at the risk of 2. Okay, it's 3% risk and 5% return, right? That's 2. For 3, it's 5% risk and 10% return. So sigma, and we'll just say expected return, sigma, expected return. So we can try to calculate the Sharpe ratio, which is basically, we'll use a simple form, this, okay? That is, given a unit of risk, how much return are you getting, okay? So it's a reasonable measure, right? So if we use this measure, investment 3 has a Sharpe ratio of 2, whereas investment 2 has a Sharpe ratio of, this is less than 2. What is this? 1.667. Yeah. So if we go with the Sharpe ratio, one could say 3 is actually better, but it's a little bit more tricky. So we'll say when it comes to 2 and 3, it depends on your risk preference. For all the other ones, we had the conclusions, right? 3 is better than 4, 2 is better than 1, 4 is better than 5. Okay? Yeah. Yeah. So this slide we'll quickly discuss. Okay? So here, what it's trying to show you is that these red rectangles are portfolios. So there should be another legend here if they were being precise. These are portfolios. And as you can see, there are 500 stocks here. These little triangles, circles, and what do you call this? Diamonds, rhombus. I don't know what it is, but you know there are 500 stocks. So I assume that these are individual stocks that are in this S&P 500 index. Okay. So what this is showing you, we're gonna use what we saw here. Okay. Basically, we're gonna look. Yeah, the conclusion here is basically if we compare the S&P 500 index, which is right here, has about a 20% volatility and an expected return of about maybe 12%, right? So if we compare this against individual stocks, one way to see this is drawing a horizontal line this way. So there are a bunch of stocks with a historical average return of 12%, right? One right here, one right here, here, and so on, okay? But they all have a volatility greater than 20%, okay? So it's showing you that S&P 500 portfolio is superior compared to any individual stock that forms that portfolio. Okay, so these are components in the S&P 500 index, but its portfolio is superior compared to all of the individual stocks. Okay, and we'll look at I'm not quite sure, but I'm assuming that this is the largest. Yeah, it makes more sense. Largest 50 stocks. Okay, one way I can guess is because, as we talked about earlier in the previous video, if you look at these triangles, they're all around here, right? Meaning, compared to these other stocks, they have lower volatility. So I can presume that these are bigger firms. Okay, so the yellow ones are bigger firms, and the mid-cap stocks, I assume, are these blue ones. Okay, so we can do the same exercise for the or the mid-cap portfolio. I'll just make this a blue rectangle or square, and I can draw a horizontal line this way and see that given this expected return or historical annual return of 15%, none of the individual stocks have lower volatility than the portfolio itself, right? There's no individual dot, for example, like right here, right? Yeah. And another way to look at this is we can draw a vertical line too. So given the volatility of 27%, does any individual stock generate a greater historical return? No, right? So the conclusion remains the same. Mid-cap stock portfolio is better than any individual stocks that are part of the portfolio. Okay, we'll see why in the upcoming slides. And same conclusion for the small stocks. Okay, so if you look at the orange ones, this one's a little bit more noisy, but similar conclusion, I'll just say. Okay. Yeah. So let's talk about why this is on the next slide. So it has to do with the concept of diversification. So this is a very important concept in investments and portfolio management. Diversification is a process of reducing the overall risk of an investment portfolio. So we're trying to reduce the overall risk of your portfolio. And the key idea is this. You want to combine stocks that have low or negative correlation coefficients. Okay? So if you remember your statistics, correlation coefficient measures the degree to which stocks move together. Okay, so degree of co-movement of stocks. Okay, so basically, uh, um, you know, let's say real quick, there are two variables, x and y. And let's say x goes up like that, and y doesn't have to go up like one by one. So let's say maybe 2, 4, 6, 8, 10. Okay, this shows you that the relationship between x and y, as x goes up, y will also go up. So this is an example of a pair with a positive correlation coefficient. Okay, they move together. The direction is the same. Okay, whereas if we had another column here, z, where it moves the opposite way. So if x goes up, z comes down. That's an example of a pair with a negative correlation coefficient. Okay? Yeah, so let's use that. Oops. Okay. So the key idea is to combine stocks with a low or negative correlation coefficient. And this example, table 8.4, illustrates the concept of diversification really well. So you want to understand this table well, and then you'll get this right away. Okay? So what it shows you is there are 3 states of economy in the world. Okay? It just means we're looking at everything from right now, time 0, and we're trying to see what happens in time 1. Okay? So basically, we're going to make it simple and say the economy could be good, boom state, just be okay, steady state, and we could face a recession. Okay? Only 3 possibilities in the future. Okay? And we have the probabilities associated with each state. There's a 20% chance that the economy will be good, 50% chance it'll just be okay, and recession probability is only 30%. Okay? And then we have these 2 companies, Zig and Zag. Okay? So company Zig will do well. It'll generate a 25% return if the economy is good, 17% return if the economy is okay, and 5% return if the economy is bad. Okay? Whereas Zag is the opposite. When things are good, it'll generate only 5%. When things are okay, 13%. Recession, it'll do well in recessions. Okay, 25%. Okay? So let's calculate, and here's a return for 50-50 portfolio. If you put in 50% in Zig and 50% in Zag. Okay? So let's calculate these things. First, let's calculate the expected returns. For Zig, the expected return is easy to calculate. Okay? So we did this already in the previous problems. This 15 is just the probability that there will be a boom times the return in that state. We're taking the weighted average, basically. Plus 50% chance that it'll be okay, the economy is just okay, and in that state, Zig will generate a 70% return, and 30% chance of a recession, and 5% return. If you add this up, you'll see that it's 15%. So that's the expected return. Same thing for Zag. Zag is, I'm not going to write this out, but 20% times 5% plus 50% times 13 plus 30% times 25, you'll still get 15. Okay? And the 50-50 portfolio is also easy to calculate. Okay? So in a boom state, we're only going to look at these 2 numbers. Okay? That is, if you put in 50% of your money in ZIG, then the return that you get is 25% on that. And you also have 50% of your money in ZAG, right? Which generates a 5% return in the boom state. So this is 15%. And same thing here. 17% times 50 plus 13% times 50 equals 15, and so on. Okay? So what's most interesting is this. I hope you're following. So both securities have an expected return of 15%, right? But there is some volatility. So the returns of these individual securities are volatile. There's some, uncertainty, right? But if you form a portfolio of those two stocks, you'll get 15% return in every single possible state, right? So that just means this is a made up example, obviously, but basically, going back to the basics, beginning, we're looking at this from time zero and saying there are three things that could happen in the world: boom, steady, or recession. But what this did was, by combining these two stocks, in every possibility, we guaranteed a 15% return. In other words, the portfolio is generating an expected return of 15%, but zero chance of zero volatility. Okay, we're guaranteeing a return of 15%. Basically, this became a risk-free investment, which provides a 15% return, which is unrealistically good, right? Yeah, but that's the concept of diversification. If we combine stocks like ZIG and ZAG that move in opposite directions, that's the negative correlation coefficient example, the portfolio reduces the risk. Here we did an extreme example where the risk becomes zero, but the risk is reduced. Okay, and that's exactly what we saw in the previous slide here. All these stocks are risky stocks. They all have volatilities and returns, right? But combining them somehow formed a portfolio that's clearly better than the individual stocks. Okay, that's how diversification works. Okay. Yeah. So we're gonna decompose risk into two components. So types of risks. Okay. So we can say the total risk of a stock or any security, but we'll just say stock. Total risk of a stock is a sum of the systematic risk and the unsystematic risk. You need to know these terms. Okay. And since the exam is open notes, you should have these down. So the systematic risk, also known as the market risk or the undiversifiable risk, is the type of risk that all firms are subject to. It's a market-wide risk. Okay? So some examples include recessions, inflations, so something that's macroeconomic. Okay? So if there's a recession, for example, in the US, let's say this is the US firms. We have like tech firms, consumer, cyclical, banks, I don't know, whatever, healthcare, bunch of other things, right? All these firms don't do well, or I shouldn't say all of them, but to be precise, but most of them, we'll just say, when things are bad in the US is just doing very poorly. All these companies that operate within the US will not do well. Okay, so It doesn't have much to do with the individual firms, but it's just a macroeconomic factor that affects all the firms in the U.S. Okay. Similar story with inflation, and also with interest rate decisions from the Fed. Interest rate decisions. Okay, things like that. Okay, so that's a market-wide risk. Okay, and for example, if World War III breaks out, then this gets a little tricky because some defense firms will probably do well because they're selling all these weapons, but we'll ignore this for now. But most firms, if the U.S. is like heavily involved, hopefully it doesn't happen, but let's say people start bombing the U.S. or something, okay? Things won't be good, right? That's a macroeconomic factor. It's a systematic risk, okay? And unsystematic risk is called the idiosyncratic risk, or firm-specific risk, or diversifiable risk. Okay, so as the names suggest, you need to know all these names for the exams. I'll use like one of them, and you need to answer the questions. As the name suggests, these are firm-specific risk. Okay, and this is the risk that is specific to the firms. Okay, and that's also the risk that you can diversify away. Okay, for example, what's a good example? Let's say, I don't know. Let's say you're a Pepsi owner, okay? But suddenly, let's say there's news that say drinking a lot of Pepsi products will make you sick. Probably some evidence there already, make you sick, but extra sick. Like you'll get really sick after like 3 drinks. Okay, then this news is firm specific, right? Only applies to Pepsi. Their particular, whatever happened, their products will be hit. Okay, sales will go down, and accordingly the stock prices will drop, right? But this is very firm specific, and their competitors like Coca-Cola will be fine, assuming that this news doesn't apply to Coca-Cola. Okay? Something like that is a firm-specific risk. Or it could be, let's say, Tesla or SpaceX. Elon Musk is a key figure there, right? So let's say, I hope he'll be fine, but let's say Elon Musk dies suddenly, okay? All of a sudden, okay? Then I would expect the share prices to drop significantly because he's like the visionary, smart guy, and he's a leader in the firms, right? And people are sort of betting on Musk too, not just the companies, right? So yeah, that's something, an example of a unsystematic risk, okay? And the key idea here is a well-diversified portfolio will effectively eliminate the unsystematic part of the risk, the firm-specific components. You cannot get rid of the systematic risk. Okay? Yeah, and this little figure shows what I just explained. This one shows you as you go from one stock in your portfolio and you're adding another stock, one more, and so on. We have a log scale. Okay, so if you add additional stocks to your portfolio, what happens to the overall portfolio's volatility? Okay, so I don't know where they got these numbers, but as you can see, as you start adding stocks to your portfolio, your overall portfolio's risk drops, okay? But the rate at which it drops slows down, and After, I think they say after about 30 stocks, you can achieve most of the diversification benefit. Uh, after, and after 30 stocks, the diversification effect is pretty minimal, and it's consistent with this chart here. Okay. Another important thing here is the portfolio risk never goes down below all the way down to zero, right? It plateaus off here, and this is the market risk. The systematic risk, as we said in the previous slide, systematic risk cannot be diversified away. It's an undiversifiable risk. Okay, you're only getting rid of the unsystematic risk, which is the firm specific risk, right? And we can see that here. And the elimination of the diversifiable risk, we're getting rid of the firm specific risk, or idiosyncratic diversifiable risk. Okay. Okay. Next few slides we're gonna skip. So we're not doing risk calculations, standard deviation calculations this summer. So you can take a look if you want. What it shows you is this this little thing. Rho is, oh, that's beta. Rho is the correlation coefficient. Okay, and it shows you all else equal. We have all else equal. As the correlation coefficient decreases and goes down to a negative number, the overall risk of the portfolio drops. You see the volatility dropping and dropping, right? It's just showing you the math, okay? Okay, let's see. Okay, let's finish this. Okay. So on the exam, you probably see a figure like this or something like this, and you will have to answer some questions. Okay. So just like we've seen in the previous slides, on the x-axis we have volatility, and on the y-axis we have return. Here, expected return, not historical return. Okay. So here we have a two stock example. Okay, let's just say in this little world there are only two stocks, Coca-Cola and Intel. Okay, and here the parentheses, number in the parentheses, the number in the parentheses is showing you the allocation of your capital into these two stocks. The first number is how much you put in Intel. The second number is how much you put in Coca-Cola. Okay, so this point right here says you're putting in 100% of your money in Intel and 0 in Coca-Cola. This point right here, you're putting in 100% of your money in Coca-Cola, 0 in Intel. And we have different allocations here, 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 and here. Okay, and for each portfolio, we have the corresponding risk and expected returns, just like before. Okay, so what this is showing you is it's labeled well. We have a part of the portfolio. What do you call this? Yeah. So the portfolios that are shown on this red line, red curve, is called the efficient part, efficient portfolios. Okay, efficient frontier. What we have down here, the blue part, is an inefficient portfolio, meaning as a rational person, let's pick a spot here. Pick something new, like let's say right here. Oops, sorry. Yeah, let's say that's the point. Okay, right there, no one should pick that point because if you look, it has a, I don't know, 23% volatility, but an expected return of about 7%. But if you go up, we're going to draw the vertical line this time. If you go up, you can do better. With the same amount of volatility, you could generate a portfolio that gives you a 12% expected return. Okay, so no rational person will choose a portfolio that falls in this region. Okay, that's why it's called an inefficient portfolio region. Okay, makes sense? Yeah. So what I do is I would like draw. I would call this the vertical line test. So based on what's given, check whether this is an efficient portfolio. You want to see if there are any other portfolios that generate a greater expected return given the same amount of volatility. In this case, such portfolio does not exist. Or, as we talked about before, you could draw a horizontal line too. Okay? That is, if we're trying to check this portfolio, we want to check, given all the portfolios that generate an expected return of 15%, is there anything that gives a lower volatility? Okay? Such portfolio does not exist, so this is an efficient portfolio. Okay? Okay. Just one more time. So choosing Coca-Cola is not a wise choice, right? If we do the vertical line test, given the same amount of volatility, you could do better right here. Okay? Instead of generating a 6% expected return, you could generate a 14% expected return. Okay? So on the exam, I'll have a bunch of statements, which, you've seen the exams a couple times now. Which of the following statements is false? Okay? A rational person will choose a 100% Coca-Cola portfolio. Is that true? Or I'll just say could choose. This is false, right? This will be the right answer because a rational person would choose not this, but something else that already exists in the world, right? Yeah, something like that. Okay, here. Yeah. So it's very similar to the previous example, but instead of using a two-stock world, we're making things a little bit more realistic and saying there are 10 stocks in the world. Okay? So the basic framework is the same. We have the volatility on the x-axis, expected return on the y-axis, and then we have these 10 different stocks. Okay? McDonald's, Walmart, Nike, and so on. Okay? And we added portfolio weightings. So the dotted, I'll just show you here. The dotted curve here represents the portfolios formed using Amazon, GE, and McDonald's. Okay, so it's just like here. Here, this entire curve was formed using Coca-Cola and Intel only, but using these three stocks, we see these dotted possibilities. Okay, and here the solid curve is the portfolio is formed with all 10 stocks. Okay, so a couple of different conclusions. First, I'll just write them here. Portfolios are obviously better than individual stocks. As I said before, we can do the little horizontal line test. So this, for example, there's nothing to the left of this point. Okay, all the individual stocks are to the right, meaning given the same expected return, these individual stocks have greater volatility. Okay, so portfolios are better, clearly better than individual stocks. Okay, another point. Okay, we'll do the horizontal line test for comparing these two portfolios at any point. Say maybe right here. If we compare this point against this point and any point right here, this point against this point, or we could do the horizontal line test. Given the same volatility, portfolio with 10 stocks is clearly superior compared to the portfolio with 3 stocks. Okay, portfolio with 10 stocks is clearly better than portfolio with 3 stocks. Okay, you're getting this, right? Yeah, I don't want to be too repetitive. Yeah, and last thing, let me erase some of these things. Oh. What else? Yeah, those are the main points. And let's do an exam question. Let's say on the exam, I have a bunch of statements again. Let's say a rational person might choose Newmont Mining over Tiffany. Is that true or false? A rational person will choose Newmont Mining over Tiffany. That's false, right? Comparing these two, they have a similar volatility, 36-37%, but Tiffany generates a much greater expected return compared to Newmont. So if you're choosing between these two securities, no rational person should go with Newmont Mining. Okay, we'll come back to Newmont Mining. Okay, how about IBM and Nike? Okay, I have to think too. So IBM has an expected return of about 18% and expected return of 6%, 18% volatility. Nike has a greater volatility, 23%, but a slightly higher expected return. Okay, so this is one of the cases where it depends on your risk attitude. Okay, again, if we did the Sharpe ratio, maybe IBM is a little bit better, but we'll just say depends on your risk attitude. Okay, but if we compared Walmart versus McDonald's, it's clear, right? McDonald's has a lower volatility and a greater expected return. Okay. One last thing, I usually ask this in class. We saw that comparing, let me clear these things. If we compared Newmont Mining versus Tiffany versus Newmont Mining, Tiffany was clearly superior if we were looking at the individual stocks, right? I always ask in class, then how is Newmont Mining able to exist in the market in the first place? How are they still existing in the market when these things are clearly superior than Newmont Mining? Okay? So the right answer is, if you thought about it, the right answer is, if we're just talking about individual stocks, this doesn't have a place in the market. Okay, it won't exist. But as we talked about, Newmont Mining serves the purpose of diversification. So if you think about the business, The mining business is related to like gold prices, precious metal prices, okay, which usually goes up during recessions and when things are bad, okay? Whereas these other companies do well when things are good, right? For example, Apple, I'm using Apple products right now. iPad sales probably go down if things are really bad, when there's a huge recession, okay? But gold price goes up. That's precisely the negative correlation coefficient that we talked about, right? So even though adding Newmont mining to your portfolio might lower your expected return of the portfolio a little bit, the diversification benefit that you get is much greater. Okay, that's how they're still surviving in the market. Okay. Okay. We're gonna skip this slide. It's the capital market line, but what it's doing is we still have the 10 stocks from the previous slide, but we're adding another security, which is the risk-free security. Okay, so if we add the risk-free security to your portfolio, you can even do better. Okay, represented by this capital market line, this little line right here. I'll use the highlighter. This line. Okay, so again, if we do the little horizontal line test, this point versus this point, this has the same expected return but lower risk, right? Capital market line is better. So adding the risk-free security to your portfolio further improves your portfolio. Okay, that's the point. Okay, last thing. We have the capital asset pricing model. Okay, so if you're a finance major, this is something you should know, right? So CAPM, and maybe you've heard of CAPM. So what it does is, well, we're coming up with a model and we're trying to model the expected return of a risky security. Okay, so I'll go through the components. We have the expected return of stock I. Okay, again, I could be Apple, could be Tesla, GE, GM, Dell, whatever. Okay, expected return of stock I is equal to the risk-free rate, the return on a risk-free investment, plus the risk premium. Okay, so we talked about this format many times. Return on a security, a risky security, is the risk-free rate plus the risk premium, right? Talked about this in bonds and stocks, but here we have a more detailed version, basically. Okay, the risk premium can be expressed as this part right here. Okay, so we have beta. That's new. Beta is the riskiness of stock I in relation to the market. You don't have to know this formula, just know that it's the riskiness of the stock in relation to the market. Let's quickly look this up just for fun. Maybe, yeah, SPY should have a beta closer to 1. Does it show a beta? Okay, here it is. So we have beta exactly equal to 1. Okay, that's because this ETF, SPY, S&P 500, follows the overall market. Okay, so it should be 1. Okay, let's look up. How do I? Or we have something beyond. Okay, some risky company. Okay. Does it have a beta? Yeah, beta has a 2.75. Okay. Rivian recently viewed. When did I view? But this should be a risky company too. As you can see right here, One day it's going up 8%, but after markets it's going down 9%. So, not as risky as I thought. 1.6. Okay. Yeah, something like Tesla. Does this work? Okay. It works. Beta should be higher, 1.8. Okay, and so on. Okay, you get the point. So beta measures the riskiness of stock I in relation to the market. Okay, and another component here is this thing in the brackets. Expect the return on the market minus the risk-free rate. That's the market risk premium. So this highlighted part is what we call market risk premium. Okay? So as we saw, the S&P 500, the overall market, the SPY ETF that I just showed you, also fluctuates daily, right? It's a risky security, right? The market itself is risky. And since it's risky, investors demand a risk premium. And that's captured like this. So I gets replaced by M, basically. And if we remove, or if we subtract RF on both sides, the risk premium on the market is Rn minus Rf, basically. Okay? That's the market risk premium. And this is the expected market return. Expected return on the market. Okay? Yeah, this formula is really easy and the problems are really easy. Okay, you should see the solutions. The only thing you have to worry about is on the exam, I'll sometimes give you the market risk premium, and I just said market risk premium is this, right? So I'm saying this is 7% in this problem, but sometimes I'll give you the expected return on the market. That is, instead of giving you this entire thing, I'm just giving you this thing right here. Expect the return on the market. So read the question carefully, and it's really hard to get this problem wrong on the exam. Okay? We're skipping example 6. And that's it.